Well, welcome to the Two Regular Guys show, a part of the Best of US Investors subscription. And today we're going to get into being right versus making money. It's something that I think a lot of people are facing right now as the last 2 weeks have been rolled out with the markets. And a lot of people saying, being heavily into the NVIDIAs, the SMCIs, the AI technology, and the whole run up, and everybody saying, it's going to the moon. And then all of a sudden, in the last 2 weeks, especially this past week, we have seen that attitude of it's the right thing compared to making money, and people are losing money. This is something that's really becomes really important to me and Mark, is that because of our collective time in this industry and in this in markets, we have been through a lot of these roller coaster rides, and we feel like we've talked about for what, 6 months now, I think.
At
Yeah,
least.
that we are coming to a end or a cycle rotation or a distribution change. And we saw it in a big way in the last week. And we want to talk a little bit about being right versus making money. And at the end of the day, Mark, as you can tell, is a little bit more tanned than usual. His making money in his lifetime of investing allowed him to take and his wife down to Florida with their friends to celebrate her birthday. And because was focused on making money versus being right, he was allowed to do that. And that's something that I think we all need to take into account. How do you fund your dreams? You fund them by making money, right?
Yeah, and I think, you and I have both been through, a lot of market turmoil. Mine was in 20, no, it was 1987 with the
Yeah.
big crash there. And then, the 2000s dot-com crash, great financial um, crisis that we had with the
Yeah.
real estate. And so a lot of people, especially in the great financial crisis and the dot-com bubble. I saw that
Yeah.
personally when I was in the business. People thought it was so easy. Everything was going up in the dot-com. Everything had a dot-com on the end of the name. Everyone changed their name. I could have a rock quarry, it was Colorado Rock Quarry. And then I'd change my name to ColoradoRockQuarry.com. And all of a sudden everyone would want to invest in it. My stock price would go up. I'm a
Right.
guy sitting there that my normal volume is 200 shares a day, goes up to 1 million. I sell out, because I have .com. It had nothing to do with .com. Okay. And I watched people, and I'm sure you did, who quit jobs or just became day traders because it was so easy and go up every day and up every day. And isn't this great? And then they did it on margin. Okay. And when you sign that margin agreement, you're signing a deal with the devil because you're signing everything away. And once that margin calls comes, they can sell out all your accounts and come after you personally also too.
Yeah.
And I saw a lot of that too. So that affected me a lot. And I saw how it affects the retail investors more than anything else. And think about even the great financial crisis. Who went to jail in the great financial crisis? Any of those executives, the ones that are playing both sides, buying and the shorting at the same time? And
Yeah.
who got who ended up with the bag? Retail investors. People
Right.
lost their job, people lost their homes, people lost their savings. Took forever for those people to come back in and start investing in the markets again. So now they have. Okay, we had
Mhm.
we had the pandemic, we've had stimulus checks. People were sitting at home. Markets went up every day, still going up.
Mhm.
Okay, buy the dip. I've never heard of buy the dip until the pandemic, and it works until it doesn't.
Right.
So now we're starting to see, it was, the markets and the indices were being driven, by basically 7 to 10 companies, and the top 10 companies in the S&P were 37, 38%, of the market cap. So we've always said, this is great. We watched charts. It's going up, ride it up. Okay. But now
Yeah.
we're starting to see some chinks in the armor. And what is that coming from? Earnings. Okay. So what propels these growth stocks? record earnings and revenues, okay, earnings, and also guidance, forward
Yeah.
guidance out of the world. We're going to double every year. Well, not everything doubles every year, and it's going to end at some point. So, we're looking at that situation right now. Tesla, Google came out with earnings. They weren't as good as everyone wanted, and it's starting to turn the market a little. So, next week, we're doing this video on Saturday. We have Meta, Microsoft, Apple, and Amazon. And if those things follow suit, if they don't have outstanding expected earnings results plus great guidance, what's going to happen to the market? I'll let you answer, everyone out in the audience. But we saw a little bit of that this week.
Right. Yeah, I think it's unfortunate because what you refer to it, I think, as hopium.
Okay.
Everybody gets addicted to this. Market's going to go higher. Things are going to be wonderful forever. We saw it during the housing bubble. We saw it during the dot-com run up in the late 90s. It's just markets work on cycles, and they are heavily related to economic conditions, which are influenced by the availability of money, the cost of money, and since a lot of the world is becoming consumer based, a consumer based world, and driven by our consumption, when we don't have money, things don't get bought, and company earnings and revenue decline. And I think that's what we're seeing. This reminds me of the whole dot-com explosion, technology driven. Dot-com was all technology. You could make anything and put an AI behind it in the dot-com boom. You put anything and you put a dot-com, like you said about what Colorado quarry or what have you.
Yeah,
You know,
yeah, rock quarry.
Rock quarry. So we're
Now
in
it's
this,
Colorado rock quarry AI.
yeah, AI
Yeah.
now, and I think we're in that environment again. And so the way I think you have to look at this is you got to look at the facts and you got to look at the numbers. And at the end of the day, this is about results. This is about what are the results, not about being right, because everybody will be right at some point in time in history in the future. It's a matter of making money, because that is truly what is driving that's how you achieve goals and dreams. That's how you fund them, you know? And so that's where I look at this and I go, in the last, I would say 6 months, the falling in love with a company or stock has gotten, I mean, euphoric. I mean, crazy high. And that, to me, that petrifies me, because that happened in the dot-com boom, that happened in the housing boom. I remember, people saying housing's never gone down in value. Well, you didn't have made up products that were leveraged at the wazoo when it came to housing prior to the big financial crisis. So what we're going to hit upon today is results. We're going to hit upon the platinum swing trading that Mark runs, and we're going to hit upon this past week's results and the prior weeks and show you some of those and how Mark thinks about putting positions on and taking positions off. And then I'm going to hit upon what money flow on a weekly basis and compare it to a couple different sectors to give you a better idea of how to possibly look at how money is flowing. So, Mark, take it away.
Well, to follow up a little bit, we've had comments about, we're just negative Nellies or whatever, but we just don't say this because we want to. Like we actually look out at the big picture of the economics that are going on. We always say, the market is not the economy. But if you look at the economy, just this week, 56,000 purchasing agreements were canceled last week, 15% of all transactions on homes. Okay. So that may not mean anything by itself, but the last time it was this low was right at the pandemic in March of 2020 when, everything was going down. Okay.
Right.
Other things, we're looking at the big banks. The big banks are putting up, raising their provisions for loans that are going bad, not only home loans or commercial real estate, but also credit cards. Okay.
Mhm.
Credit card debt, all-time highs. Credit card failures and delinquencies, all-time highs. These, again, on their own, don't mean much until you put them all together.
Mhm.
Look at car repossessions. We all know increased by 23% compared to last year. Okay.
Wow.
Why is that? Interest rates are high. Average car payment, new car, $740. 15% of people, okay, who have car payments pay over $1,000. We're starting to see those repossessions come in.
Mhm.
Okay. It's so you add them all together, and we talk about it on the regular guy show all the time. And those kind of things will catch up to you. And like Trent, like you said, if I don't have money to pay my car payment, then and I have to pay my house payment, which my insurance is going up, my property taxes are going up, that isn't in the CPI or the PCE or whatever the Fed says is great. Those are going up.
Mhm.
I have to still
Yeah.
eat, feed my kids, take my car, drive it to work. I have to pay gas. That's stuff that's hurting now. So
Yeah.
if I can't go and I don't really care about AI or what Microsoft's doing at that point because I'm just worried about feeding my family. And 65% of the people in this country live paycheck to paycheck. Okay, that's what we're looking at. Okay.
Yeah.
Now, it's going to happen tomorrow. Don't know. But I'm just saying it's building. Okay. So just be aware. And that's
Yeah.
why I look at, and I used to be more long term and let it sit there and go through the downturns. And I'm like, at where I'm at in my age now, I don't want my money down for 12 years or, 6 years or whatever, waiting for it to come back to even. And so that's where I started looking at charts and technicals to help me know and give me a higher probability of a better trade. Okay. And that's
Yeah.
where we came to swing trading. So we'll take a look at a few of these of
All
what we
right.
did last week. Okay.
Cool.
I'm going to share my
Sounds like
screen
good.
here. Okay. Let's go here. Share. And here. So this was, and again, I went on vacation last week, so I only looked at 3 stocks last week, and I put them out on Sunday, and I said, "I'm on vacation. You got to take a break from this stuff." Turned out to be a pretty good week to take a break because of the way the market acted. Went
Yeah.
down all week except for Friday, because of the GDP was so great, allegedly. So when I put this out, you know, oh, where are we? 1, 2, 3, 4, 5. We hit about right here is where we put it out.
Okay.
Okay.
This list goes out on Monday morning, correct?
Yeah, or Sunday night. I did this Sunday night because I had to catch a plane at 4 in the morning.
Okay.
And so, we watched it and the markets went down, for several days. But we looked down and we saw a good oscillator called the MACD. We saw a good oscillator called the stochastic. And we saw an RSI. These are 3 oscillators that I use. I use very simple oscillators. We
Mhm.
also looked at Bollinger Bands. Okay. And
Mhm.
Bollinger Bands is another tool that I use. And I use moving averages. I use the 50, the 9, the 20 EMA, okay, and the 200. And I'm not going to go through how we all do it. You can join
Sure.
the channel and we'll figure it out. But once we cross over the 9, it gives me a better idea on a short-term swing trade. And we got in, okay. And it never did come down and touch what we call support, which was be the 9 or resistance, first level on the Bollinger Band. And we just
Mhm.
kept riding it until about, what was that, Wednesday. You can see it came up, hit a stop or hit a limit order on the Bollinger Band. So basically on ABV, we made about 2.2% or $3.88 a share. Now, you can see earnings came out. My personal trading guidelines, I get out before earnings because it could go either way. I've seen it go. This one happened to do well. And then it went up Friday, but it also hit my green line in the sand resistance level here. So if I would have stayed in, which I wouldn't, because I don't violate my trading plan, I would have gotten out here, and it would have been a good gain. So this was last week when it was pretty bad, in the
Yeah.
market. And another one that we did, um,
So you're identifying companies that have the opportunity to move upward in probably in the next 5 to 7 days
yeah, or
is the
well, remember
approach.
these oscillators and these moving averages
Hmm.
reflect data from the past.
Yep.
So it doesn't reflect forward data. But when you see movements and momentum like going up, okay, like we're seeing on the oscillators, that increases the probability that our momentum and our direction is going to be the same. Okay. So
Okay.
here's BMI, Bristol Myers.
Mm-hmm.
Same thing. We got in right back here. Okay. It's above several of my moving averages. It's above my oscillators. So it went on the list. Now you don't have to buy it. You don't have to do anything. It's on the list. You don't even have to use my trading plan. You can make your own up. I know,
Right.
Trent, you have your things that you look at that are different than mine that you feel
Mm-hmm.
more comfortable with, and that's great. But you can see we came up and we popped it up, and again, I was on vacation. This just hit a stop or a limit order that I had, and I set it where just on the first level of resistance, the Bollinger Band. Okay, so
Okay.
BMY we were up 3.31% or $1.41 a share. Okay. And then again, next day it went up and it went all the way up because of earnings. Earnings came out, big gap, went above the 200, came right below the green line of resistance. And we'll see what happens. Can it stay above the 200? But I don't mind getting out and I don't mind missing this because I cannot, I stick with my trading plan. So I will take, the 3%, the 2%, and take the money out and let it sit and find another place for it. If I can't find a trade for it, I'll set it in a treasury,
Yeah.
for 30 days.
It's
And a lot of the guys and gals on the Platinum channel, that's what they do. So what are they doing? They're not, they're not letting it sit, in their bank account at, 0.3%, 0.3% interest. They're putting it over in treasuries and getting, 5.4%, you know.
right.
So we move money where the value is, but we also get out. A lot of people don't know when to get out. And so they just ride these charts down. And before you know it, you're 20 or 30% below.
Yeah.
Now let's look at the one out of the other three that really didn't go our way, but we didn't really lose uh, all that much. So Baxter, okay. So Baxter was above the 9. It was above a lot of my moving averages, and it was just above the MACD. But what happened is it just went sideways, and so this white line's where we got in, and it just kept going, and it went down, and it finally hit below initial support, and it popped out. And so we popped out at 0.323% loss or 8 cents a share, which is good for me. Some people will come down to another line of resistance, they'd still be in. Okay, it just depends on your risk tolerance. I'm very conservative. I don't like losing money. Number one
Right.
rule is don't lose money. Number two is don't fall in love with the stock. But a lot of people make the mistake, Trent, and you know this, they don't know when to get out. They get
Yeah.
in and then they write it down because what they want to be is right. Like you said, this is
Yeah.
a great stock and they got a great president and they just hired this guy and they're going to get a contract I hear from the government is, it's going to go here, it's going to go there. But why is this stock going down? Well, I'm going to stay in it till I'm right, because I'm right. Well,
Right.
you're not always right. And so you lose money. Okay. Let's look at another one. This was last week. Last week was a little, or 2 weeks ago, last week, it was a little easier because there was a rotation out of, the high tech and into the Dow and into the small cap. So here was John Deere. Okay. So what happened with John Deere is we had a big swing down. And then we came up and we had a candlestick above the 9. Okay.
Mm-hmm.
And some people use 9, some people use 10, some people use the 5. Okay. You can use whatever you want on the shorter term. This is a daily chart. And we got in and this thing rode up. Okay. Until it hit right below. Here's the 200. 200 is a big line of resistance. It's hard to get past that.
Okay.
You can see it's struggling and got past. But we set a limit right below the 200 and got out on John Deere. John Deere, 4.02% gain. Okay. It's under the 200. That was about a gain of 14.67 a share. Okay. In a couple days. Get
That
out.
was that was
And look
2 weeks
look,
ago.
this was a week or two ago. Yeah.
So that was the
Oh, well,
week
let's
of
see.
the 15th.
Yeah, because we got in on the 12th and we got
Uh-huh.
out basically on the 17th. And then
Okay.
you can see what happened. So we got out here,
Yeah.
went up, boom, then it went down, then something happened, came back up. And now we could consider this another trade, because we're above the 9, the 200, above this initial support level. And we could, technically could trade this again,
Yeah.
but we got out. We didn't know when this was going to come back. This could have went down like this.
Mm-hmm.
So we got in, we got out. All right, we're down. We might get in. We'll see. I haven't
Yeah.
decided.
Very
Let's
cool.
go with a smaller little stock. Okay, let's go to Newell, NWL. So Newell trading here, it was going sideways. Okay. And what we saw basically, where did we get in? Oh, we got in right here when it came down and touched right here. Okay, the nine. It went sideways, went sideways, went sideways. Okay. Hold on. I'm wrong on this one. Sorry.
Sorry.
Newell, we got in here. Okay. Sorry about that.
So this is the
Uh,
week of the 15th.
this is the 12th again. Yeah, we got
Yeah.
in.
Okay.
And we got in. Sorry about this. We do a lot of charts. So we
Yeah.
got in right as we closed above the nine again on the day. Okay.
Okay.
So we got in. This rode up. And what did it do? It hit our first level resistance, which is this upper Bollinger Band.
Okay.
Okay. And that's where it got sold. So it doesn't seem like much. We got in at, wherever this is 628 or whatever. We get out at, you know, uh, 674 or whatever, but we made 60 cents a share, but that's 9.5%. Okay.
Yeah.
I'll take 9.5%,
Right.
in a couple of days, but then what happened? It hit that Bollinger and it went down. Okay.
Mm-hmm.
Now came back up. Look what happened. I can't predict that this is going to have a huge old candlestick like this. So now we'll watch it again. But we got out. A lot of times these will just continue to go down. They'll follow their Bollinger Band down. But again, out with a prize. Um, so those are the kind of things that I look at. You
Yeah.
know, and then if I don't find anything, sometimes you don't. We wait. We say we wait for the market to present a setup for us. And in these
Yeah.
down days, the market is just looking for a place to provide us with a setup. So some days we don't trade at all. Some days we're not in the market. You don't have to be in the market every day. And I always say every day, when in doubt, sit it out. And too
Mm-hmm.
many people get caught up in the emotion. And if you don't have a trading plan, you don't have an investment plan, I can almost guarantee you're going to make mistakes. Okay. Even if you think you're going to be right, you're not. Okay.
Yeah.
And I think a lot of people are going to find out on some of these mega techs, like we saw last week, when their earnings come out, it might not be buy the dip anymore. Again, it may be, but from the charts that I'm seeing, we could be in for some issues if those earnings don't hit as high as the expectations we've seen.
That's true. And
So
I think and that's the thing is, you're talking about 3, 4%, one case 9% return in a matter of a couple of days. You do those kind of things a handful of times a year and not expose yourself to all the risk of the overall market, you can have a really good annual return with a very low risk rating in a sense. And I think at the end of the day, if you think about how money managers manage money, they look at downside risk all the time. And if you can, if you put, say, a big majority portion of your investments especially in treasuries right now, where you're making 5% or so annually, and then you learn to swing trade, and it doesn't have to be on a day to day or week basis, but just learning to catch the swings in stocks and indexes, you can really crank out an incredible annual return of your portfolio and take less and less risk. And I think that's really the emphasis here is it's about that result. At the end of the year, did you make money over and above, say the S&P, over and above the index? And how
right.
much risk did you take doing it?
And
So,
this isn't easy. If it was easy, everyone would do it. You have to put work into it and you have to make it your system and your priority.
mm-hmm.
Okay. If you don't do that, then you're gambling, in
Yeah.
my opinion. So, I mean, we have a paper trade portfolio and we track when I put it on when the stock goes on to the watch list. Okay. Not a buy price when listed. If there is a better price that I might get in, I'll highlight that in yellow. But you can see we're, a little over halfway through the year. You can see where we are. And we paper trade 100 shares of whatever we do. Okay, we just assume 100. It's a good round number. And then You have commentary of where we get in, where we get out, the date we get out, gain or loss. You can see we've had some losses. Um, this was last week. We only did three because I was on vacation, but it was up on a paper trade $516 for the week, even with our loss. Last week, $4,900. Okay, total since the beginning in paper trade only, about $94,000
That's the
just
first
in
of the year.
these. Now, and that's not saying you get in at this price. This is the price when I listed on this, and you'll have to figure out what your entry price is. Okay.
Yeah.
But in a majority of these, they go up, and I'll show you where I see support and resistance, and you can learn how to do your own support and resistance. And other charting software has their own, levels of support and resistance, but they're pretty close to the same. Everyone sees.
Hmm.
Um, but you can do this, but start out like we do here, paper trade. You know, don't start out
Practice.
by taking, yeah, practice. You just don't go out on golf, and play the game, or you don't go, you don't go snow skiing if you've never been snow skiing before and take the lift all the way to the top of the mountain. Okay. And then try to ski down because you'll never ski again. What
No,
do?
that's true. You blow
You go
yourself up.
you take a day of skiing lessons,
Yeah.
so you learn the basics. And that's paper trade. You're not, they take you up to the bunny slopes. Okay, this is the bunny slopes. And they teach you how to slow down and stop so you're not out of control, how to get on and off the lift, all that
Hmm.
stuff before you start actually skiing. And that's
Yeah.
what this is. Yeah.
Yeah.
So
And the great thing is you have a community for which you can participate and talk to other people and get ideas. You have Mark and myself and Kerry to bounce ideas off of and learn from. And I think that's a big part of this is the learning element and having a community to work with overall. It's a big thing.
and
Yeah.
that's not for everybody. And there are really good financial advisors out there. If you have one that, I recommend having people watch your money who know what they're doing,
Hmm.
but also ask them the questions, you know, why is my account only, if the S&P went up, 14%, how come I'm only up 6% or 2% or 7%?
Yeah.
That's a legitimate question.
Or flip it. The S&P's down hypothetically, let's say 10%. Why am I down 15? Why
Right,
am I down? Well, what's the strategy to prevent loss?
right.
So I think and I think in the coming months and year, that could be the bigger question is what is our exit strategy? What is our risk management strategy?
Yeah.
If it's
And a lot of them
just
will say they won't. They'll say you're well diversified. And when the low tide, when the tide goes out, all boats sink or all boats
that's
get lower. And what Buffett says, you can see who's swimming without their swim trunks on.
right. Yeah. Well, hey, I wanted to jump on a little bit about money flow and where money has been flowing for the last week.
It's an important
So
topic.
it
Yep,
is an important. I believe so. I think this is insightful. So I'm going to share my screen here. Um, and let me know when you can see this.
it's there.
Okay. Let me bring this down here so it doesn't block anything. So this is what I've got here is what we call ratios, and it's a comparison between one type of investment and another type of investment. So I'm using ETFs, exchange traded funds here. And I'm comparing the XLK, which is the technology index, which has all the Mag 7 stocks, the technology stocks, plus many others. And I'm comparing it to a handful of other ETFs. So in this first one, I'm comparing it to the utility index. So when it comes to risk, they're very opposite ends of each other. And what you're seeing here is this red line represents the first one in my ratio is XLK, and my second compare the XLK versus XLU. So as you can see here, if I go back, this is a weekly viewpoint. I like to look at weekly because it gives me better viewpoint of what's happening. If I go back to 2020, we all remember what happened in 2020. We had, of course, the pandemic happened, and in April of 2020, XLK or risk uh, was put on because money became very available. And as you can see on a weekly basis, this being the I believe I have this as the 20 period moving average or 20-week moving average. XLK outperformed XLU. So technology outperformed utilities and did very well up until January of 22, when we saw a downturn in technology and an upturn in risk off or risk off assets like utilities. And we saw that come down up until January of 23, which then risk came back on and people exited in this case, XLU, and went back towards technology in XLK. And we had that massive write up until April of this year, when we had a drawdown, exit out of technology and risk. But it came back in June, and we had more money come back into technology, where it then peaked in July 1st. And then that's when everything really changed. And since then, as of this week, we're seeing more money flowing out in the last 26 days out of technology and into more risk off assets, like in this case, utilities. Let's take a look at another category.
And they go to
XLF.
utilities because they get a dividend. Basically, they're seen as safe.
Yeah, it's seen as safe. It's a dividend type, companies like Southern Company pays out a dividend. It's not, it's not sexy like technology, but it's a needed asset class. This is XLF, which is the financials. As you can see, technology, um, same scenario with the pandemic, rise in technology. From there, we saw more money flow into the financials in relation to technology. And we saw then back at the beginning of 23, rise in risk, more money flowed into technology. It did, in comparison to the financials, it went basically sideways up until May of this year. More money flooded into technology versus financial index. But we then again saw that turn at the basically first of the month of July, and we've now seen more money flow out of technology into the financial sector. We then take a look at XLRE, which is real estate, and we've seen more, since 2020, rise in technology, more return in technology versus real estate. We did see that pivot a bit and go sideways. And then there's a lot of this can be attributed to the rise in interest rates. So the cost of borrowing money for a mortgage dampened the real estate market. And in beginning of 23, we saw that rise in technology all up until the first of this month, July 1st. And we have now seen more money flow out of technology and back towards the real estate environment. Once again, it pays a dividend. A REIT pays a dividend in most cases. The risk here is, on a commercial level, is a lot of those loans that commercial real estates have taken out are coming due, and they're having to refinance at a higher rate. So that becomes, if I'm looking for a risk off category, real estate in this case may be, depending on what you're investing in real estate, could be the lesser of your allocation when I look at this element. But we are seeing a move out of technology and more towards real estate in this case. We look
Some
at
of that, Trent, would be like, because now there's all of this expectation of 3 rate lowerings before the end of the year too.
true,
So real estate would be more attractive
favorable
if that happens.
if that happens.
Yeah.
We'll see. This is XLV, which is the healthcare sector. And you can see the ride we've been on since 2020. Technology has done very well up until 22, when we saw it turn south, technology versus healthcare. Healthcare did better from 22 up until the beginning of January 23. That's when money came back into technology versus healthcare, and you saw that rise. But once again, we get to July 1st, and that pivot happened again. We've seen more money flow out of technology into healthcare. Typically, in a recessionary environment, healthcare is one of those categories that outperforms versus technology in many other categories. And then we'll look at one more, and this is XLP. This is consumer staples. This is necessity items for us to continue to live. Groceries, basic needs kind of things. And if you go back to 2020, technology, of course, outperformed up until 22, January of 22. Staples did better versus technologies. And then, of course, you had the pivot in January of 23, and technology has risen again. And as of July 1st, once again, technology money started flowing out of technology and into consumer staples. What I'm looking for is this break in all these indexes that I've just showed you in comparison to technology, a continuation downward. If I see a continuation downward in these, I'm seeing more money flow into the comparison index versus XLK, the technology index. So in this case, staples, if we continue to see that throughout next week, and we can see it throughout the month of into the mid, into August, what this is telling me is there's a flight to safety, and consumer staples, healthcare, real estate, XLRE in this case, and what one was I missing? XLU. Utilities are typically where money gets distributed from risk on, technology as an example, to risk off. So when you can create these charts in TradingView, it's just create a ratio and compare the indexes. You can compare this with really any stock or bond market, anything like that. But what I'm looking for, what this is telling me is where is money flowing to? Because if the money's flowing to technology, as we saw from 2020 to 2020, end of or beginning of 20 or end of 22, or beginning of 22, that's where money's going. So when you allocate your portfolio or allocate your risk model, that gives you an indication you're going to make more money in technology versus utilities. But when that changes, that's when you reallocate your money. And this is honestly, this is where major money managers are looking at. They're looking at where is money flowing and what's influencing that flow. And so these are great charts. I'll continue to put them up on a weekly basis on the Best of US Investors website for our subscribers, because I think it's telling. It's telling us where this money is really truly going versus what we hope it to be, where we hope it to go. So overall, definitely check out ratios to manage risk and manage where your money is, where money is flowing.
And to back that up, if you look at the 3 picks I had for last week, they were all healthcare.
Yeah.
Okay? Baxter, Bristol Myers, and AbbVie.
Yeah. That's of how you take that in account to how you select your swing trade stocks each week. Where is that money flow to versus where it's flowing out of? And you'll have more winning trades and more winning investments than you do losing if you follow some of these rules overall.
There's a higher probability of it.
Absolutely.
Yeah.
So
but you need to follow your own trading rules. Develop trading rules or develop your investment plan. Stick to it and modify it if it needs to be modified.
Absolutely. And I think that's the thing is investment plan isn't always 100% all the time. Nope. You as you mature as an investor, so does your investment plan. So as does your risk tolerance. So but yeah, I think these are two things. At the end of the day, like we said, it's not about being right. It's about making money. And if we keep that in mind, it'll help us navigate these markets much, much better as we go forward for sure. So, well, Mark, do you have anything else you want to chime in with?
No, I think it's Saturday and we should go watch the Bitcoin conference for a while.
There you go. This will be interesting. Yep. And well, cool. Well, thank you for joining me and Mark. We are two regular guys. We do this every week. Typically, we have our show on Wednesdays, so definitely check that out. And also, try us out. We have a 14-day free trial with Best of US Investors. We'd love for you to join. We'd love to get to know what your goals are and help you achieve them through managing your money, risk managing, and building part of our becoming a part of our community. So in the meantime, have a great weekend, and we will see you later.
See,
Peace.
cut.
Good. Awesome. Thank you.
Yeah,
All right. I don't have the energy I did most days. Uh,
I'm still getting off vacation mode and trying to catch up on everything. Then we're going to a pro-am rodeo tonight with our friends. So that,
oh, fun.
well, it is, but if I can get all my shit done, yeah. Otherwise, it just puts me further behind.
Right.
Yeah.
Well, well, cool. I'm gonna put this up tomorrow morning at 7, so hopefully get some traction with it and go from there. But thank
Okay.
you for doing this. It was
Yeah. Well,
good.
thanks for inviting me. I don't mind. I love doing them. Yeah.
Yeah, and so do I. I mean, maybe next week we can do a couple live YouTube if I can figure out how to do the split screen. I think that would be
Okay.
good. Yeah. Um just but yeah, let's do that. But if I don't talk to you later today, have a good Saturday and I'll probably talk to you tomorrow or text you.
Okay. All
So,
right.
talk to you soon.
All right. See you later.
Bye.